Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, July 19th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we have futures pointing higher, even after yesterday's weak action in the afternoon. We are looking at the Dow Jones Industrial Average currently, futures up about 200 points. S&P around 30, NASDAQ just a little bit under 100. So things do look like we'll get off to a pretty good start. Crude oil down a couple dollars a barrel, back down to about $100 a barrel. And the 10-year Treasury yield up about 3 basis points to 2.98%. I tell you, market got off to a pretty good start yesterday morning. We saw early morning strength, but then the afternoon turned weaker. And normally, after a little bit of a run to the upside, getting up near resistance, when I see that happen, I grow a little bit more defensive. But we are seeing futures up a little bit this morning. We'll see whether or not, I think the key is going to be whether we can take out the highs that we've seen over the last month. And we'll talk about that in just a couple minutes. First, let me take you over to earningsbeats.com. If you scroll down, for those of you that are new, if you scroll down, we do have a free newsletter, Earnings Beats Digest, name, email address. You can just type that in, hit the subscribe button. We'll get you all set up. There's no credit card required. You can unsubscribe at any time. 3 times a week newsletter, very quick read, couple paragraphs and a chart. I think you'll enjoy it. But again, go over to earningsbeats.com, scroll down, find that area, and make sure you sign up. We do have free events from time to time. We had one last night. And whenever we have those, we do invite everyone from our Earnings Beats Digest community to join us. So it's another way to learn a little bit more about us and how we approach the market. Today's agenda, let's go ahead and go through that. I'm going to start off with the daily market recap, jump into talking technically. I'm going to take a look at the NASDAQ 100. We've seen a pretty decent month since the middle of June. And then let's see what kind of, which stocks within the NASDAQ 100 have been outperforming over this period. I think that'll be an interesting exercise. Then we'll get into earnings spotlight and wrap up with the 3 you must see. But let's go ahead and get this thing started with the daily market recap. So on Monday, we saw the Dow Jones Industrial Average finish down 215. Yesterday, we woke up to really nice futures. Dow futures were up 300 points. Got off to a really good start. You can see the Dow went up, just about tested its 50-day moving average, probably the closest it's been to its 50-day moving average since back at the beginning of May. So it'd probably been, I don't know, close to 10 weeks. But anyway, the Dow Jones started out there. We were strong in the morning and then turned around and finished near the low of the day, closing back down just a little above 31,000. S&P 500, similar pattern. You can see almost up to the 50-day, reversing, finishing down 32 points. NASDAQ finished down 92. Early in the day, we were actually above the 50-day moving average for the first time since back probably the beginning of April. So things are definitely improving, but we couldn't sustain it. We did finish down near the low of the day, down $92, back down to 11,360. I'd like to see us get a close back up above about 11,700. I think that would be a good number, a good target to shoot for there. Mid caps down almost 5 points, small caps down a fraction, but all 5 of our major indices did finish down after trading much higher earlier in the day. So we did get a little bit of a reversal. Earlier, I said futures are up, though. Let's see if we can get back above yesterday's highs. That would be a good short-term goal. Energy led from a sector perspective, gaining just a little bit more than 2.25%. Not surprising at all to me. We're been pretty beaten down. We did lose neckline support around 70. We've come back up to that level. Got the falling 20-day moving average sitting at 72.20. I'm not sure we get back through that 20-day. We'll see. Discretionary also up yesterday, which was encouraging, I think, given that the overall market was down. Discretionary up a little more than 0.25%. We were up above that 50-day moving average, came back down, closed just beneath it at 145.26. 50-day is at 145.52. So we had it, the breakout early in the day, came back down, closed just below it. Probably at the open, we're going to get a little bit of a movement back up above the 50. We'll see if it holds today. Materials, the last of the three sectors that actually ended the day yesterday in positive territory. Materials gained about 0.25%. Like energy, though, in a downtrend, I have my doubts whether or not we get back through that 20-day on this trip. We'll see. That 20-day right now is at 74.22. So we do have another couple dollars to the upside. We'll see whether or not we can get up there and get through that 20-day. Healthcare, worst performing group on Monday, dropped more than 2%, $2.75, finished at 127.45, just below the 50-day. It's been trading a little bit more above the 50-day than it has below it over the last couple of weeks, 2-3 weeks. So it's been an encouraging sign. You can see the top that the XLV had back in May, right around 133 or so. Then last week, or maybe the latter part of the week before, we'd gotten up to about 132. So that's going to be an area that we need to negotiate on healthcare. We need to get back through that 132, 133 level. In the meantime, watch 125. I wouldn't want to see the XLV go back below 125. Utilities continue the downtrend. It too was off quite a bit on Monday, finishing down about 1.4%. If this group loses 68 on the close, I have a feeling we could go back down to test this double bottom from back in February and June. That would be down close to the 63, 64 area. 10-year Treasury yield. Let's get an update. Make sure we have the latest there. We do have, I think it's existing home sales out later this morning. I didn't go back and double check, but I kind of recall we have housing reports coming out this week. Yesterday, we had the housing market index, which was very, very disappointing. Today, I believe it's existing home sales, and maybe tomorrow, new home sales. I'm doing this off memory, but there is a report coming out on housing around 10 a.m. this morning. So be on the lookout for that. 10-year Treasury yield, though, right now up just slightly, 3 basis points, 2.96. But we were up earlier to up over 3.02%. So we're off of that earlier high. I'm still seeing a downtrend here. I mean, if we get a breakout above about 311, then I think we'd have a chance maybe to resume the uptrend. Until we see that, it seems to me like the path of least resistance is to the downside. And again, with inflation, the reports we had last week, you would think the 10-year Treasury yield would be going higher, and it's just not. It's in a downtrend. And until we get above that, say, 311 area, I would expect that we continue to move lower in this 10-year Treasury yield. All right, talking technically. Always like to start off with the S&P. Got a dark cloud cover candle yesterday. That normally is a short-term reversal, especially if you're coming up off of an uptrend, even though it was just a fairly slight uptrend. We were above the 20-day. We failed, went right back below it. You can see the last 2 times we went through the 20, failed, reversed back down. It led to some more selling. It did it there. And then again, about a week and a half ago, moved back through the 20-day right here, reversed back down below the 20, kept going lower. Today will be interesting because we are looking to gap higher. If we can get up and take out the 50-day moving average and take out these recent highs, and I'm going to say right around 39.25. I think I mentioned, looking at a 1-month chart. Let's take a look at that S&P. Here's the high up here, 39.40. Here's 39.20. Here's 3900. And you can see once we rolled over, back down we went. Rolled over, back down we went. The only difference I see with this one is that we really didn't have the strength long enough to see a negative divergence. Here, when we set this last high on the hourly chart, the PPO had rolled over. Here, as we're setting this last move to the upside, PPO was rolling over. Here, we just went up, set the high, and then back down again. So maybe, it would be obviously much more bullish to go higher than to go lower. But here was gap support from the S&P 500 when we gapped up on Friday. So we went all the way back down and tested that level, getting down to 38.18 and change. If that holds and we can turn her back around and go through not only 3,900, but get through to 39.20 and 39.40 and close there, that starts to put a whole different look on the daily chart. Again, we go back to the daily chart. If we break through 39.40, right now the 50-day moving average is 39.27. So this short-term area, and when we were coming down, 3,900 was support. Now that 3,900 area is serving as resistance, and the 50-day 39.27. So if you break above that level, it starts to look much more bullish on the daily chart. Still not guarantee we're out of the water and we're done with the lows, but it begins to look a lot more like that. And one of the patterns I was looking for on this way down was maybe a left shoulder, left side of the neckline, a lower low to put in the reverse head, and then eventually come back up. It's starting to get a little sloppy here. But if we get back up, maybe to 41.75, maybe even 4,200, then come back down one more time later this summer, maybe put in a right shoulder, reverse right shoulder around 3,900. Maybe we'd launch from there into the fourth quarter. I'm just speculating, just looking at the chart, speculating on possible patterns that we could see. But moving through the 50-day, that could be the next step. If we can get through that 50, maybe we make a run up for 41.75 to 4,200. Volatility index. I'd watch this low here on the VIX, which is right around 24. Friday, we got down close to 24. Yesterday, of course, the market was a little weaker, especially later in the day. And the VIX did move up 4.4%. But now today, we've got the market up. Futures are up. And if we do see a decent day, does the VIX move back down here below 24? Now, I did have a question that came into my show over at Earnings Beats yesterday. And by the way, for those of you listening at StockCharts, if you want to join me on Mondays and Wednesdays, because this show airs Tuesdays and Thursdays here at StockCharts. Monday and Wednesday, I do a show over at Earnings Beats. It's also a free show. If you go over to Earnings Beats, and usually you just come in on the home page there, but there's a link up here, Trading Places Live. If you come in after about 8:45 in the morning, like if you come in right now, any other time when there's no show, you're going to see this, which is the last recording of the show. But if you come in about 8:45, between 8:45 and 9 o'clock, the morning of the show, there will be a link here. And all you do is click on the link, you come right into the room. So that's Monday and Wednesday. So if you like the Tuesday and Thursday show, come on over and join us. So anyway, I would be watching maybe this VIX area around 24. But the point that, was made, or the question that was raised in the last Trading Places Live episode over at Earnings Beats, question was, what should we be doing as far as, buying, individual stocks, ETFs, are we in a bear market? Are we in a bull market? Well, everyone's got their own opinion, of course, and this is just mine. But I believe that we are in a secular bull market. I have believed that all year long. I've believed it since 2013. That was April 10th, 2013 is when we broke out on the S&P 500 above the highs established in 2000 and 2007. So when we made that breakout on April 10th, 2013, that was the day, in my opinion, that the secular bull market was born. This one. So the 2018 trade war, when we went down the fourth quarter, cyclical bear market, because it's part of a big long-term secular bull. The 2020 pandemic, cyclical bear market. Big one, 35%, painful, 4 weeks, but still cyclical bear market. Turned around, went back to new highs. When we started this, beginning of the year, I suggested it would be a cyclical bear market. inflation, recession. Of course, we didn't know the war at that point, but inflation, hawkish Fed, then recession. Now we've got the trade or the war. I mean, there were a lot of issues, and sentiment was set up. We needed to reset sentiment. We had wrong groups leading at the end of the year. I mean, there were a lot of things that went into it, but I believed that the first 6 months of 2022 would be the cyclical bear market, and then we would start to turn back higher and ultimately resume the secular bull market. And I haven't changed a thing. I continue to believe that's exactly what's going on here. Now, at bottoms, you know, when we're looking at the S&P 500, you know, I tend to get a little bit more defensive when I'm buying at a bottom, because if I'm wrong and I'm in individual stocks, I'm going to get hammered to the downside. So I would rather do ETFs. So something like the QQQ, Spider, I think being in that right now is fine. My retirement accounts are in the QQQ, and that's, when I saw the signals of a potential bottom in mid-June, I went all in on the QQQ, and I'm still there. What would take me out? Well, if we go back down to new lows and we see our sustainability ratios roll over, then yeah, that would take me out. Otherwise, I'm sticking with that. I'm sticking with the QQQ. I'm sticking with being long, and I'm sticking with being heavily invested. Now, from a trading perspective, I think it's a little bit, you know, when I trade, I trade. I don't just put money away and turn away and walk away from it. I'm looking at it every day. Yesterday, I didn't like the way the market finished, so I ended up moving back into cash. Now, do I think we're going back down? I don't know. Am I going to short? No, I'm done shorting. Unless the market convinces me that my bottom call in June was wrong, I'm done shorting. So I'm on the long side. I'm mostly trading leveraged ETFs. But even if I went long right now, I would not be back in a leveraged ETF. I would do something. When I'm talking about leveraged, I'm talking about something like the QLD, which tracks the NASDAQ 100 at a 2-to-1 clip. QQQ tracks it at a 1-to-1 clip. Now, because we're up near resistance, if we started to turn higher and I decided to get into an ETF at this point, it would probably just be the QQQ. I don't think I would be doing any more of the leveraged right now. Now, if we break back through that 50-day moving average, I could easily be back into the QLD, because I believe we're going higher. And that's a key resistance area. If we can take it out, I can get into the leverage. If we lose the 50-day or maybe the rising 20-day, I can always get back out of the leveraged ETF. But if I think we're going to be in an advance, if I think we're breaking out, we're going to make a run, believing that we're in a secular bull market, I want to be a little bit more aggressive with the ETFs. The problem is individual stocks. You know, one software company comes out with bad earnings and you're holding a software company, you could be down 10% at the open. And, you know, that gets really frustrating, especially if the overall market goes higher and you're just, you know, in the wrong stock on the wrong day. So until we get a real uptrend established, I don't think it's established yet. Once we get an uptrend established and we can see where the leadership is, then I'll start moving much more toward individual stocks. But right now, it's more for me about being in on the long side, but trying to manage my risk. All right, let's move on. Let's take a look at, let's do the NASDAQ 100. So what I wanted to do for this is pull up the NASDAQ 100. I'm not sure what, oh, okay, that was just in there to compare. So let's do a summary view of the NASDAQ 100 components. And let's just do it for 1 month. Let's see what's been leading over the last month. This could be, I'm not saying it is, but it could be a sign of leadership in the next phase if we break through the 50-day moving average. Off of the bottom of the S&P 500 in mid-June, we've now gone about a month. Here are your NASDAQ 100 leaders. And sometimes I'll just look, is it, what groups are leading? What industry groups? I mean, the names are important, obviously, but are there any themes over here? Well, I'm thinking of this top 7, 3 are discretionary stocks. 2 more in the next 5. So it's 5 out of 12. 5 of the top 12 are discretionary. If I look over the last week, let me find, there's the S&P 500. So over the last month, the S&P 500 has gone up 4.25%. So everything above this line is outperforming the S&P. Everything below the line is underperforming the S&P. So we go all the way down here at the bottom, and there are a few discretionary names at the bottom as well. And they're in different groups: broadline retail, travel, recreational products. So not really getting any kind of theme there. Internets still seem to be kind of weak. We got 3 internet stocks here down toward the bottom, underperforming. So still got some work to do there. Not really seeing anything else though. But yeah, you can look at some of the names. I mean, stay-at-home stocks. There's Peloton and Zoom over the last month. They're the bottom 2 performers in the NASDAQ 100. Booking Holdings, I'd consider that another stay-at-home kind of a stock. I mean, if people are out traveling, Booking should be doing well. Anyway, these are the 3 at the bottom. Go back to the top, looking at the stocks. Moderna, very, very strong action just over the last 30 days. TCOM, ctrip.com, Qualcomm, Costco, Okta. This is the best performing software stock over the last month within the NASDAQ 100. Let's take a look at the chart. Not really seeing anything just by looking at the absolute chart. If you go back down, or actually, let's set this up on a relative chart. There's the reason. You can see relative to software, it's moving up. Relative to the S&P 500, it's moving up. So that's why it's near the top of the list. I wouldn't exactly say that this thing's flying just yet. We do see a little bit of strength in the AD line starting. I think we've got to get above this level right here on Okta before I'd grow a little bit more optimistic. And that would be the 107.02 area. We got about $12 to the upside. Now, we are trying to trend. You can see the 20 has crossed back up above the 50 for the first time since we went below it back in November. So this absolutely could be the start of an uptrend, but I need to see there's a double bottom. Here's the high in between. We've gone up to kind of test it. I think we need to get that close back through 107, 108. All right, let's move on, talk a little bit about earnings. So we've got earnings starting to accelerate a little bit. IBM reported last night. This was one that I was really waiting for a couple of reasons. Number one, you can see it looks like IBM's been accumulated. Unlike most stocks, IBM's been moving higher this year. And look at the relative strength versus its peers and versus the S&P 500. This is a nice looking chart. I definitely expected a good report out of IBM. And they beat on the top line. They beat on the bottom line. However, if you look at the price action pre-market, IBM down 5.7%, down to $130. Let's go back and look at the chart. Now, this is a buy on rumor. I think this is a sell on the news. And I actually like IBM. I was talking about this last night. We did a Q2 earnings webinar. And I actually like it there. There's a gap support. We tested it once. We haven't lost it. It looks like we're going to open down close to it. I think if we test that area, I could buy IBM at that level with a closing stop beneath 127.50. And if you need an intraday stop, I don't know, pick one of these lows if you want. But I usually use closing stops because I've seen so many times like this, where you go below gap support or any support intraday, and then you come back up and hold it at the close, and look what happens afterwards. That right there, that little tail, that's where market makers are gathering shares. Now, one of the things they talked about on, with IBM was the strength of the dollar and how that is expected to impact earnings going forward. When it comes up to earnings and then they bring up this excuse that shouldn't be an excuse, I always scratch my head. It's like, okay, who didn't know that the dollar was rising? Here's the chart of the dollar. We all know the dollar is rising. So coming out and using this as an excuse for, your current earnings or your future earnings, well, this should already be built in. You got a lot of smart people evaluating these companies. I'm talking about people in Wall Street firms, lots of MBAs. You think they don't know that the dollar's rising? That's a pretty big, steep increase in the dollar this year. It broke out. I think this pullback and the media's reasons for it to drop are an opportunity to buy. That's what I think. We'll see. Let's see where IBM opens, how it finishes today. But I think that 127 area, we just go back and look at that 127 area right in here, 127.50. That's the level I'd be watching on a closing basis. J&J reported this morning. They were down they were up slightly pre-market. They did, I think, I didn't get the earnings, but it seemed like there was some disappointment there. And they too were talking about the rising dollar. But when we look at this one on a relative basis, you can see J&J relative to its pharma peers recently about a 6-7 month relative low. So it's hard to expect a whole lot out of J&J. The AD line pretty good. I just think it's in this trading range, 167.5 up to 185. Let's see which way breaks first. One more we'll do real quick. Halliburton, they beat 49 cents versus 45. They were up slightly pre-market. Can they get back through the 20-day moving average on a closing basis? I'm going to say no. If they do, that would certainly be a little bit more bullish for the stock. But I think we could see a failure at the 20-day and then a pullback. It's just the way I see it at this point. All right, 3 you must see. Let's wrap this thing up. First, we're going to start with Enphase. Enphase has been pretty strong, bouncing off this 50-day moving average, but it's really struggled to get through 220. AD line's improving. Enphase relative strength is great. Got to get through 220. If we do, this one could be a really nice stock going forward. Beigene, BGNE. I just like this one the way it's been trending higher. It's in the biotech area, so obviously very risky, but it's been holding 20-day tests on recent pullbacks. We're near the 20-day now. I would expect to bounce from here. And then the last one I have for you is NTRA. This one I would be careful about. Look at this massive volume and gap down and sell off. We had a reversing candle right at this area. I would expect this stock to move lower from here, but we'll see. Anyway, that's it for me. I appreciate everybody tuning in. Again, go over to earningsbeats.com, sign up for the EB Digest, and make sure you come join me tomorrow morning over at Earnings Beats for your next Trading Places Live episode. Anyhow, have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.